So now we're going to move on to Brian. And in fact, I think there was equally interesting tax consequences and evolving tax issues in crypto. And Brian's going to tell us all about it.
Thanks very much, Don. Well, okay, so hopefully everybody can see this. The whole crypto area, clearly it's not going to disappear. My first client that I was referred to is actually 2017. I feel like 5 years ago. It feels like 20 years in the crypto environment. So this individual was a senior commodities trader in Chicago for a major bank. And so he was basically setting up a platform in the cloud to mirror the Chicago Board Commodities Exchange. He was going to issue tokens so you could be trading in the cloud. And so I looked at this structure, and well, you're not actually trading, you're not taking ownership. It's really just a kind of a derivative that looks at the prices and you're buying and selling. And I said, yeah, that just sounds like gambling. You're not taking any ownership. And the guy looked at me and he says, well, isn't that what the stock market is anyway? But the key issue was trading on the commodities exchange, huge commissions. So when you're moving money, when you're doing transactions, I guess they call it the gas fees in the crypto arena, the transaction costs are significant. And so crypto actually significantly cuts those transaction costs down. So the big banks at first were afraid of it. Now they're starting to get into it because they realize it's not going to go away. And the different platforms and the cost structures are huge. So Bitcoin and Ethereum are very expensive in terms of the transaction fees. That's why you'll see crypto.com. Their fees may be 1/10. And so they're taking off because they're basically able to significantly discount to their investors. What you have on the front page, I decided to stake my son a year ago. And so occasionally I check in and see, well, how's my investment doing? So I said, let's see what kind of NFTs you've got. And so he sent me these pictures of NFTs. And the top left and the bottom right are what are referred to as mad meerkats. And if you remember the Lion King, there were meerkats. And so these things started about a year and a half ago. And at least according to my son, I haven't checked the pricing out. He invested a few $100s, and now those two meerkat images are worth $5,000 each. Now, intrinsically, you get in these chat clubs, support groups, a new platform comes out, and you really can't tell where the values are going to head. I saw in the Wall Street Journal recently, Bill Gates and Elon Musk were debating, and Bill Gates said, anybody who doesn't have a lot of spare change or isn't significantly wealthy should stay out of the NFT area. And Elon Musk, oh, that's a pretty good, just one of the options to consider investing in. But the other NFTs on this page are worth a couple of $100. Are they going to drive up or not? There's so many variables going on that determine price. So I'm going to jump into the tax area right now. But before I do, I'll just flip to the next slide on page 3. And I won't dwell on this too much, but if you look at the very top transaction, mining activities are really taking off because the value, the gas fees or whatever you call it, the very first transaction, and this is what's interesting about blockchain, you can trace through all the transactions. You don't know who the individuals are by those coded numbers, but in that first transaction, there were 368 transactions in 33 seconds, and the fees awarded were 2.12 Ether, which translates into about $7,200. So what's happening is the mining activity. We've seen a number of companies come over from China. It's not really looked on fondly in China. So the number of companies, mining enterprises, are moving to the U.S., Ohio, states like that where there's cheap access to energy. But anyway, we'll see a lot more mining activities. We can go to the next slide, 4. So in the IRS world, I would say it's still the Wild West. The IRS is struggling with this. Essentially, if you're with Coinbase and they're tracking transactions, they feel good that you get a 1099. But once you're in the area of wallets, those are private ledgers, and there's no self-reporting. So the IRS is grappling with this. But initially, they did issue at least some direction on how do you classify what to report. So in 2014, they issued a notice, and they basically came out with a definition saying tokens, cryptocurrency. It's virtual currency as they refer to it, but it's not taxed like a currency like francs or pesos. It's not that kind of currency. It's a special set of rules. It's basically, and it's not a stock or security, although for legal purposes, it could be if there's a major issuance or an ICO. For tax purposes, it's property, and generally it's a capital asset. So if you're buying and selling tokens, NFTs that you haven't created, you're going to pay capital gains tax. If it's held over a year, you'll get a long-term gain, and the top tax rate is down below there. What happens if you're awarded tokens for your mining activities? And this notice clearly set out this is a trader business. It's like you're a self-employed individual. It's ordinary income, and it's also subject to self-employment tax. So as a general rule, if you're really in an active business where you're making a market, as opposed to an investor, you're subject to the top rates of tax, plus self-employment tax. So it's a pretty steep tax rate. If you're operating in the U.S., you're just basically estimating your taxes and paying on a quarterly basis. Corporations, there are two types of company activities. One is basically if you're an active trader business, or even if it's capital gains. So an active trader business, a good example is if you're building out a platform and you're going to issue utility tokens that are going to raise some funding for the company. Well, companies are subject to a flat tax rate on active trader business and capital gains. So there's no real distinction, whereas individually, you've got capital gain long-term if you hold it more than a year, which in some cases isn't really applicable. People are flipping these things quickly. But for companies, it's a flat 21% rate. If you have capital gains, once again, there's no distinction. So in Elon Musk's case, I think Tesla unloaded $2 or $3 billion. While investing in crypto isn't Tesla's activity, is basically the tax is taxed the same way. If you're creating tokens, you're issuing tokens, kind of like a phone card for future services. Generally, when you receive the cash for those, call them utility tokens, that's going to be ordinary income. But once again, once you have things run in a corporation, it's pretty straightforward as far as dealing with what the tax outcomes. Just have to net everything out at the end of the year and determine your taxable income, capital gain or otherwise. Foreign taxpayers, it's a really big subject. I'm going to touch on a little bit more later on, but there are a lot of funds. I know we have a number of bankers from major banks with international operations. So generally, foreign investors, if they're trading in tokens, they're outside the U.S. These are investments, unless they happen to have a U.S. residence or there's a foreign company with the U.S. presence. Foreign investors, even if it's a U.S. token, these are going back to the definitions, just property, like a stock, not technically a stock. Someone said it's more like a commodity. So foreign investors going in and out, foreign companies investing in and out of tokens, and this is up in the cloud, so they don't really have a presence in the U.S. On the other hand, if you have a foreign company with an office, a real active trader business in the U.S., a presence here with employees, they have to deal with all the regular U.S. rules and file returns. Let's go to the next slide. IRS guidance, it's been pretty sparse, really. So here are a couple of references. There was a Rev ruling, and you can search this on Google and read for yourself. 2019, it included a whole list of FAQs, which I'm referencing down below. And the FAQs, they don't really clarify that much. How do you tax the gains? Well, it's property, it's not currency, it's capital gain or loss. It actually doesn't address airdrops. It does touch on forks, and so does the Chief Counsel Advice Memorandum. It's 4020. So there have been a number of hard forks where a major virtual currency will split. And essentially, these forks creating a new currency, the IRS's view is that's going to be ordinary income. It's taxed when you receive it. And that brings up a whole host of issues. At the bottom, I referenced a Jarrett case. And so this, there's two questions. Is it taxable? Almost always yes, if you benefit from some token award. The question is, when is it taxable? So the Jarrett case is sort of pioneering new areas as to when things are taxable. So for example, if you get a reward because you've invested in some token or in some exchange, you can be assigned a reward. Do you have restrictions on that reward? Do you have constructive receipt? So the whole area, the Jarrett case basically was a situation where the investors did do staking, they did get rewards, they paid tax on it, and then they realized, we haven't really monetized out of this reward or the basic token. So they filed for a refund. Initially, the IRS wouldn't allow the refund, but then they later stepped up and said, okay, we'll issue the refund. But then the taxpayer wants to take this case all the way through tax court to get an actual ruling. And simply put, the Jarrett sort of approach was, well, I'm like a baker. I've got a product, I'm going to stake it, and I get rewards, but I shouldn't really pay tax on this until I sell my cake. It's not until I've really monetized it. And so because the amounts involved were so small, the IRS didn't want to take it to court, but the Jarretts themselves are pushing this to try to get a ruling. The IRS was happy to walk away and give them the refund. But if you watch the Jarrett case, it's going to have a lot of implications on the timing of when rewards or staking benefits are required to be reported. The other Chief Counsel advice on 1031 exchanges, it actually related to there's a major tax act passed at the end of 2017. And so for trades, exchanges of tokens prior to 2018, there was a lot of controversy. Could you get tax-free exchange treatment, like if you're swapping real estate or you sell a property, you don't take the cash, you reinvest it? The IRS basically said, well, we're looking at Litecoin, Bitcoin, Ethereum, and we don't view these tokens as equivalent or like-kind property. So they ruled against the taxpayer for transactions before 2018. After 2017 or 2018 forward, there's no dispute. The legislation came out and it basically said crypto tokens are not eligible for 1031 treatment. So you can't swap around and think you can tax defer it. Let's go to the next slide here. Page. Okay. Just going through a few accounting to give you some idea of what you have to track or how you deal with this if you're an active investor. Generally, if you have something called a sale or exchange, you're going to trigger a taxable event. So if you're holding Ether and you bought it for X and it's now worth Y and you swap it or sell it, you're going to have income recognition. Again, no 1031 tax deferral on exchanges. How do you keep your books and records? If you're in and out of tokens, there are a number of rules in the accounting world, the tax accounting world, and generally first in, first out. So if you are buying a number of tokens and selling those tokens, it comes down to keeping a good set of records, which is a challenge. Back to my son, I asked him how he's tracking his token exchanges, and in this area, it's all over the map. Unless you're with an established exchange issuing 1099s, it's your books and records, and so the obligation is on the individual to maintain adequate books and records. Are you selling the first token or ether token, or are you specifically identifying because it has a higher cost basis and you would rather sell that and reduce the tax, or is it the last in, first out? The key is, if you keep track and there's software packages out there, if you need to just maintain consistency. Haven't yet seen IRS audits on this. They will come up. The IRS is really focused on trying to pin down how to tax people based on accounting that often isn't done. Moving from one wallet to another, that's not a sale or exchange. So there shouldn't be a taxable event merely from going from, a lot of times individuals will set up a separate wallet. They'll have this a main wallet, and then they're going to do some transacting. They're afraid of hacking, so they'll set up a second wallet for other transactions, whether it's staking or mining, etc. And again, it's been looked at a lot. People still want to try to find a way to get like-kind exchange treatment, but right now there is no way to get tax deferral on exchanges. Okay, let's go to the next slide. I'm going to move through this very quickly in the last few slides so we don't run over time. We've talked about NFTs. So if you're creating NFTs, these aren't capital transactions. You're creating an asset, like an artist, like a musician. So if you create or mint your own NFTs and they're out there selling them, that's all ordinary income. Just as a side issue, right now the IRS isn't sure, but they don't like the idea of NFTs being held in IRA accounts. There are certain collectibles that are disallowed to be held from qualified plans. So there's yet to be any announcement about the IRS. This is just sort of rumblings. That doesn't. Tokens, on the other hand, are okay. That's like a commodity or just a physical, not a physical, but an intangible asset. But collectibles fall into quirky area. So probably want to get some advice before you try your Roth IRA on investing in NFTs. Okay, next slide. What are the consequences of setting up a business with tokens? Generally pretty good. If you're with other investors and for whatever reason you're going to form a partnership or a corporation, you can contribute your tokens, your NFTs to a partnership or corporation tax-free. There was some controversy initially. Say, for example, you had Ethereum and one of the other investors had Bitcoin and other exchange assets, the tokens. In some cases, if you're basically diversifying from what was a holding in one or two tokens to going into a company or partnership that had a whole lot of tokens, so you all of a sudden diversified your ownership. So far, the IRS hasn't taken that on. That's still okay. And the reason is tokens are not considered a stock for tax purposes. So you can go into partnerships or corporations, assign your assets at the beginning, and get equity back or equity in tokens if you're also issuing tokens. Next slide. So we see a lot of these corporate structures in place. This is a interesting area. So let's say, and we've had this come up several times, and nobody yet is stepping up to the plate. The question is QSBS. So if you and several investors purchase stock in a qualified U.S. business, active trader business, and that business issues you stock. If it's qualified U.S. company and you sell that stock after a hold period of 5 years, you can exclude 10 million or more of the capital gain. So the questions come at us a number of times. Well, what happens about investors set up a company, they incorporate it and issue stock? Okay, that's great, qualified for this exclusion if you hold it for 5 years. But what if you're also getting utility tokens or equity tokens? Utility tokens, forget it. That's just a commodity. You're not going to get stock treatment. But if you look at equity tokens, they can mirror the same terms, the same legal rights as a stock. So why shouldn't an equity token issued by a company, U.S. company, a qualified U.S. company, why shouldn't that also satisfy the QSBS? So if there's a later sale, if you're willing to hold on to it for 5 years, for this $10 million QSBS exclusion. So far, I haven't found, law firms want to stay away from calling equity tokens equivalent to stock. It gets into the securities area. But when you drill down, they really should qualify, but most advisors are hesitant to say equity tokens can get you the same QSBS exclusion as stock. So if you're thinking about it, get good counsel. Okay, next slide. I'm just going to touch on this. It's a complicated, Eric mentioned about ICOs. And so here's an example of a transaction we helped 2018 and 19. A company was formed called NewCo, and it raised a significant amount of cash with something called a SAF, or a simple agreement for future tokens. It's kind of like a debt instrument. So the buyers up top are buying a debt-like instrument, seem to get away from this around the securities issues. But it's a future token you're buying. So for tax purposes, this platform below that was going to provide services, the tokens could be used to purchase those services. The platform didn't actually kick into gear for 2 years. So they raised $45 million for tokens. That funded the company. It wasn't taxable income because it was like convertible debt. When the platform was final and the tokens were then released over a period of 2 years, then the staggered period, 2 to 3 years later, the token income had to be picked up by the company. It was a huge deferral of recognition of tax, and tax business deferral is a big deal. Let's go to the next slide, and I'll go through just a reference. A lot of employers are using tokens like stock options, and the rules are interesting, but for key employees, sometimes when the stock value is really high, it's hard to award employees stock without a huge tax consequence. If the company is already dealing with or going to issue tokens for whatever its services are, that's an opportunity or way for a company to issue potentially very high value for almost a nominal amount, so it nullifies the tax consequences, whereas issuing stock that has identifiable value, it's problematic when the company's worth a lot. Next couple of slides, and I'm going to be wrapping it up in a minute or two. Why don't we go on to the next slide? These are complex foreign rules. I'll just give everybody a warning. If you're going to play around with foreign companies, be careful. So in this example, U.S. investors transferring tokens to a foreign company, where there's a lot of trading activity, two things happen. If you transfer appreciated assets to a foreign company, that's a taxable event right immediately. If the activity in the foreign company is basically investment trading, that'll also flow up to the controlling U.S. investors. So dealing with foreign companies doesn't defer the tax. It can trigger and turn capital gains into ordinary income. Next slide. Why don't I flip and just go to the following the PFIC slide. This is a very complicated area with foreign companies actively doing business offshore. But if we go to the next slide, 15, be aware, if you're investing in foreign funds that are trading crypto, foreign funds generally get defined to be pass the foreign investment company status. The outcome is that the trading activity in these foreign funds, you can either pick it up currently by an election, but if you wait and defer recognition of that income till you later sell or get a distribution, you incur ordinary income tax plus an interest charge, which really, after you defer something for 12 years, the tax consequences are greater than the actual income you're recognizing. So be aware, if you're dropping money into through your brokerage account or whatever in the foreign funds, you have to check to see if it's a PFIC entity or not. Next slide. I'm going to look just advise on one particular compliance issue here. It's 14457. It's the second and first and second point. Since 2019, tax forms have required you disclose if you're holding or trading a crypto account. So the IRS in February came out with a voluntary compliance update. So if you think because of non-disclosure of your trading activities, whether onshore or offshore, and you may be subject to criminal evasion for not reporting it or not checking the box, this is the form you and your advisor have to go through. And this is a really tough area. If somebody steps up and we've had clients or new prospects, they have several $1 million of trading 2 years ago, they didn't report it. So the IRS has now upgraded their voluntary compliance to include crypto transactions that haven't been reported. And there's no standard answer as to what to do. If there are no criminal, if you got good advice and what you've done is, or you got a tax opinion, or you've been well advised, you probably don't have to deal with this form. But if you've just blown past a lot of transactions without reporting, and it's significant, you've got a problem. You might want to deal with counsel under privilege as you go through this tax form, which you can Google up on the web. And the rest of the forms down below, if you're playing around with crypto offshore, you've got a lot of disclosures, so don't overlook these. These are significant penalty areas for non-compliance. And that's it. Hope I haven't scared you away. Thanks. Hello?
All right, now I'm unmuted.
Back to you, Don.
Right, thank you so much for that. I will say there's comments coming in, giving praise to everybody for their presentation and the information, so it was excellent. Thank you so much. And Brian, your conversation and Eric's before that, I used to be a partner in a global law firm for a long time, and I'd bring clients in and they'd have to talk to securities people and have to talk to tax people, and it reminded me the only thing that required more hand-holding than talking to the securities partner was talking to the tax partner. So often trying to translate things, because it's a lot of information and really difficult to comprehend for those who are frankly not familiar with any of it, right?